today are as follows. Explain the scope of individual income tax for residents and non-residents. Explain the various types of income liabilities and personal reliefs. How to compute an individual income tax liability taking into account personal reliefs. Illustrate the tax computation for individual tax. Illustration of tax computation format for non-resident individuals deriving Singapore source employment income as well as other Singapore source income. Before I go on further, I would like to take a minute to broadly explain what is individual tax. Under the Singapore tax rules, revenue, gains, or commonly known as income derived by an individual sourced in Singapore is subject to tax in Singapore. Singapore's individual tax rate is a tiered tax rate for its tax residents, while non-residents are taxed on the higher of the resident rate or a flat rate of 15%. This module on individual tax will allow you to appreciate the concept of what are the taxable income for individuals, as well as the various reliefs that's available. In addition, you will need to understand how to present an individual income tax computation in the prescribed format. First, we start off with understanding why tax residency is important. The tax resident of a taxpayer, be it an individual or company, is important as it will determine how and whether the income of the taxpayer will be taxed. This also helps to determine tax rates, relief, and other tax benefits where applicable. For individual, the test of residence can be determined using what we call the qualitative and quantitative tests. The definition of being a tax resident in Singapore includes an individual who is 1. Physically present in Singapore or employed in Singapore other than a director for 183 days or more. The 183 days or more refer to the total number of days an individual is in Singapore during the basis period of 1st January to December 31st of the calendar year. Unlike for corporation, where you are able to select your accounting basis period at incorporation, an individual is taxed on his income received on a calendar year basis. Therefore, for testing of residency, we typically also refer to 183 days or more in a calendar year. For example, the basis period of an individual for the year of assessment 2021 will be 1 January 2020 to 31st December 2020. And this will be the period that we'll use to determine residency for that particular YA21. The expression resident in Singapore is defined in Section 2 of the Income Tax Act as follows. An individual means a person who in the year preceding the year of assessment resides in Singapore except for temporary absences, therefrom as may be reasonable and not inconsistent with a claim by such a person to be resident in Singapore. It includes a person who is physically present or who exercises an employment other than as a director of a company in Singapore for 183 days or more during the year preceding the assessment. In relation to a company or body of persons, means a company or body of persons the control and management of whose business is exercised in Singapore. For the purpose of individual tax, we'll be focusing on the first two areas. The last bullet point refers to companies, and that will be covered separately in the corporate tax module. While the first two bullet points may be a mouthful, let me provide some practical example as to what these two criteria actually mean. So, for example, if you are a Singaporean with a family, home, everything in Singapore, but you travel frequently either for work or leisure, your number of days physically spent in Singapore may be less than 183 days, but that doesn't ordinarily make you a non-resident. You will still be considered a tax resident of Singapore. The second bullet point typically covers foreigners who are exercising an employment in Singapore. For these people, the natural roots and family ties are outside of Singapore. But if they exercise an employment or physically present in Singapore for 183 days or more during the year preceding the year of assessment, they would also be considered a Singapore tax resident. For example, we are in 2025, and to assess an individual's tax residency for YA 2025, we will look at this criteria for the duration of 1st Jan 2024 to 31st December 2024, whether a foreigner is physically present in Singapore or exercise employment in Singapore other than being a director of a company for more than 183 days. If the answer to that is yes, the individual will be considered a tax resident of Singapore. It is important to distinguish that a tax resident of Singapore does not alter the nationality of the foreigner. The foreigner could still remain as a US national, German national, France national, but considered as a tax resident of Singapore for individual income tax purposes. You will be critical not to mix up nationality and tax residency. Singaporean can choose to assess as a resident if he exercises employment inside Singapore for more than 6 months in a calendar year. Physical presence or employed in Singapore at least 183 days for a continuous period of 2 years. Regardless of the period of presence, an individual is considered a resident if he stays in Singapore for 3 or more consecutive years of assessment. Therefore, the general rule, as I mentioned, is Singaporean would typically be considered tax resident of Singapore. Non-resident is an individual who does not meet the criteria of the tax residency test as mentioned above. General rule is an individual is considered to be a non-resident if one does not have a permanent residence in Singapore and has not stayed in Singapore for more than 183 days within a calendar year. Next, qualitative test for test of residency. Based on the qualitative test, an individual is resident in Singapore during the 12 months immediately preceding the year of assessment. Temporary absences from Singapore are disregarded if the absence from Singapore is substantiated and is reasonable. The qualitative test is based on the period of physical presence in Singapore or employment exercise in Singapore other than as a director of a company. Now, let's go through a very simple example to understand the concepts that we have been articulating earlier. In this question, Mr. Korn, a Singapore citizen, was seconded by his company to overseas to work for a related company for the year 2021. At the end of the secondment, he returned to Singapore and continues working with the Singapore office. State the resident status of Mr. Korn for YA 2022. In the proposed answer, the conclusion here is Mr. Korn is still regarded as a tax resident of Singapore for YA 2022 based on the fact that he normally resides in Singapore and his absence is temporary. So, for this point, it is very important to note that the general rule with respect to a Singapore citizen, despite being seconded or undertaking his employment overseas, there is a high likelihood that he will be treated as a resident of Singapore ordinarily as long as he can demonstrate that he will be returning to Singapore at the end of his work assignment or period. Now, we would like to also talk about the administrative concession. So earlier we covered the situation where a foreigner who does not meet the general rule of either exercising an employment of more than 183 days in Singapore or being physically present in Singapore for more than 183 days would be considered a non-resident for tax purposes. In addition to the rule, the IRS have introduced two administrative concession, also commonly known as the 3-year administrative concession and 2-year administrative concession, to facilitate the testing of the residency of the non-resident. So first, we cover the 3-year administrative concession. A foreigner, other than the company director, who is physically present or exercise employment in Singapore continuously for at least 3 consecutive YA, will be regarded as a resident for all the YAs, even though he may be physically present in Singapore for less than 183 days in the first and last YA. So typically, the situation here is a foreigner starts an employment with a Singapore company, say in September of 2023, and his employment lasted all the way until March 2025. From the perspective of the first year, which is 2023, he has only exercised employments for 3 months, September, October, November, December. And during the last quarter in Singapore, for 2025, he has also exercised an employment for another 3 months. Therefore, he would have ordinarily failed the tax residency test. However, under the 3-year administrative concession, because he has been working or exercising an employment in Singapore continuously for at least 3 consecutive YA, he will be treated as a tax resident for all the 3 YAs for Singapore individual tax purposes. Next, the 2-year administrative concession. Under the 2-year administrative concession, a foreigner who is physically present or exercise employment in Singapore for a continuous period of at least 183 days over a 2-year period would be considered a tax resident for both years. Similar to the earlier example, if an individual started employment in October of last year and continued his employment into 2025, ordinarily, because of his number of days in Singapore and exercising employment for last year, it's only 3 months, the foreigner would not be able to meet the 180 day and 3 days threshold to be considered a tax resident. However, under this concession, if he continues his employment and when we add up his total period of employment or his physical days present in Singapore to 183 days or more for the 2 YAs, he will still be considered a tax resident for both of the YAs. Here, it is important to note that the administrative concession are typically targeted at foreigners who are exercising employment or coming to Singapore physically for work so that they can be entitled to the benefits as well as the reduced tiered tax rate under the individual income tax regime. This is aligned with Singapore's policy of attracting global talents as well as making sure that these talents are also treated fairly from a tax perspective for individual income tax, similar to a tax resident. So here, what we have is a pictorial depiction of what we discussed earlier. So as you can see, for the 2-year concessional rule, for employment period straddled across 2 years, year 1, year 2, year 3, what happened is we have an individual who have only worked 100 days in year 1 and 100 days in year 2. If we view them individually, the individual should be considered as a non-resident for tax purposes, as he or she has not met the criteria of exercising an employment for more than 183 days in Singapore during the respective YA. However, if we apply the 2-year concessional rules, the individual would be considered a tax resident for both YAs, as if you add up the total number of days, it will be 100 and 100, will be 200, exceeding the 183 days requirement. Next, we also have a pictorial depiction of a 3-year concessional rule. So similarly, we look at the timeline and there is year 1, year 2, year 3, and year 4. Assuming the foreigner commences employment in year 1 and only have 100 days of employment, working continuously throughout year 2 to year 3, and leave employment at the end of somewhere between year 3 to year 4, spending only 10 days. Again, ordinarily, if we apply the general rule, he will not be considered a tax resident for year 1 and year 3, as the duration of his employment did not exceed the required threshold of 183 days. However, because he has worked or was under an employment for a full year in between year 2 and year 3, the total number of days being considered would cause him to be a tax resident when we apply the 3-year concessional rule. Tax basis is based on any month determined as its accounting year end. For sole proprietor or employment income derived by individual, the basis period must be from 1st January to 31st December of a calendar year, except in a situation where the sole proprietor determine their accounting year end to be any other date in the year similar to that for a corporation. For income derived by an individual in Singapore, it is taxable in Singapore regardless of the place of payment of that particular income. It is taxable based on the period in which the income relates to rather than being received. So, for example, if you are an individual exercising an employment in Singapore with a Singapore company, however, you receive your salary in your Hong Kong or US offshore bank account. It doesn't matter if the salaries are being paid to your offshore bank account. The income that you derive from your employment with a Singapore company, it's still taxable in Singapore. It is also taxable based on the period in which the income relates to rather than received. So, for example, even if you get your December salary in the next year, which is in January 2025, for example, the December 2024 salary will be taxable in calendar year 2024, despite the fact that you only received it in January 2025. An individual can typically earn the following types of income, and these incomes are taxable in Singapore. So, for example, employment income, which you would derive by undertaking an employment with a Singapore company under Section 10(1)(b). Dividend and interest, which you can earn either from investing in or shares of companies or receiving interest from bonds, debentures that you own, that will be under Section 10(1)(b). Pension, charge, or annuity, that will be Section 10(1)(e), as well as rent, royalties, premiums, and other profits arising from property, that will be 10(1)(f). The basic rule of taxing employment income derived by individuals. Employment income is taxed based on the period which the income is earned. And as mentioned earlier, the basis period for employment income is always the calendar year from January to December. The timing of payment and the placement of payment is not important. Not important in the sense that it does not affect the taxability of the income which you derive. As mentioned in my earlier example, as long as you undertake an employment with a Singapore company, regardless of whether the salary that you receive is paid to a bank account in Singapore, and regardless of whether you did receive your final month or final few months salary in the same calendar year, your income will be taxed in the whole of the calendar year based on the income you have earned. Employment income is sourced depending on the place where the services are rendered. The general rule is if you are hired by a Singapore company, your employment income is generally sourced in Singapore unless you are able to prove otherwise, such as the company deploying you to its offshore affiliate for a significant amount of time where your salaries and bonuses and all the other benefits are also being charged to the offshore entity. After we understand what types of incomes an individual may be taxed in Singapore, it is also important to understand that there are several types of income that an individual is not taxed on in Singapore. Do note that these exemptions are specifically applicable to individuals only, should not be applied to a partnership, a corporation, or any type of other forms that are not an individual. So, for income derived outside of Singapore, remitted to Singapore is tax exempted if it is remitted by an individual. So, for example, if me as a Singaporean, I work for a US company and based out of San Francisco in the US, I will be earning a salary out of the US company and I might be leaving the US for 2 to 3 years. And when my employment ends, I still need to return to Singapore, right? That's where my home is. So if I remit the income derived in the US into Singapore, it is not taxable under this exception. Next, receipt from insurance policy or investment is generally exempt from tax. So, for example, for those of you who are in Singapore, you may have experienced agents trying to sell you investment linked policy. For those of you who are not from Singapore, it might also be common in your country where when you visit banks or you have friends who are in the insurance industry, they will try to sell you investment linked policy where you have to pay a certain sum each month as a form of saving and you will receive a lump sum which includes the amount that you are paid plus an incremental amount which represent your returns from investment. Such income is exempt from tax in the hands of an individual. Next, profit from sale of property is usually not taxable unless you are in the business of property trading. So the overall concept here is Singapore does not tax capital gains. Unlike other countries such as China, Malaysia, Singapore does not tax capital gains. As such, the concept is that only revenue gains derived by individual would be taxable. In terms of property, generally for an individual, the profit from a sale of property is treated as non-taxable as a form of capital gains. This is, of course, could be debunked by the circumstances, depending on whether or not you are actually trading in property. But if you are a normal individual and in the course of your lifetime in Singapore, you upgraded from one property to another and you make a gain from the sale of the property that you live in, it is generally exempt. Lastly, deposit interest from approved bank and licensed finance company is also exempt from tax. So one common way to understand this is that typically when you place a deposit or when you have a bank account with a local bank, which will be called such as DBS or OCBC, these banks in Singapore will provide a return, right, in the form of interest based on the amount of accumulated deposit you have with the bank. May not sound like a lot, but overall in a year, depending on the amount that you deposit, it could be from several hundred to several thousand Sing dollars. Generally, this income are also exempt from tax in Singapore, so there is no need for you to report it in the income tax return. Next, we move on to a specific Section 13 exemption. So Section 13 exemption would cover income derived from employment exercised in Singapore for not more than 60 days by a non-resident individual in Singapore, excluding directors and public entertainers. If you recall, in earlier part of this webinar, we had talked at length about the importance of determining tax residency. In this case itself, we also need to ensure that for non-resident individuals who are undertaking very short employment in Singapore to keep below the 60 days requirement in the calendar year to ensure that its income will not be taxed. So for example, if a foreigner comes into Singapore, undertake a contract job for a month, the income it derives in Singapore for 30 days is not taxable in Singapore based on the exemption. However, this exemption excludes directors and foreign entertainers. So for non-resident directors, they will be subject to a 22% withholding tax, and the rate has been raised to 24% since January 2023. As well as non-resident public entertainers, they will be subject to a 10% withholding tax, and that was raised to 15% with effect from April 1st, 2022. The non-resident public entertainer's income is exempted from tax in Singapore if the visit is substantially funded by the government of the non-resident public entertainer's home country, or if there are some specific exemption provided by the government. You may recall one of the very famous saga a while back where it was reported that Taylor Swift's concert in Singapore actually was supported by the government, and there was some tax benefit provided to the singer to host their concert in Singapore. This would be one of the potential exemption that the Singapore government could provide, as Taylor Swift will be a good example of a non-resident public entertainer being physically in Singapore and derive Singapore source income. Other kind of non-taxable income, dividend income is exempt from tax for an individual. Withdrawal from CPF is tax exempt. For those who are based outside of Singapore, CPF stands for Central Provident Funds. It is basically our social security regime where every month both the employer and employee will contribute a certain amount to the government, capped as under the name of an individual, and the amount is to be withdrawn by an individual after a certain age, usually the retirement age at the point of time that you started working, so that it can help the retirees to fund their cost of living expenses. And of course, any receipt that is capital in nature is generally exempt from tax. Some examples include sale of a car. So if you have purchased a car, used it, and sold it making a profit, that profit is also exempt from tax unless you're in the business of being a car trader. Next, we talk a little bit about the individual tax rates. Clearly, the most important aspects of determining tax residency is because the tax rates applicable to a resident and non-resident is different. Here, I would like to emphasize again that tax residency has nothing to do with nationality. The prescribed rules for tax residency have been discussed at length in the earlier part of this webinar. Therefore, I will not go into greater details. Please refer back if you are still in doubt. However, what you need to remember is for Singapore tax residents, they will be subject to tax on their individual income on a tiered rate. For a non-tax resident, they will be subject to a more punitive regime where you need to do two calculations. And first is using the resident rate, and thereafter apply a flat rate of 15% and take whichever that is higher. So the rationale of doing this is to ensure that the tax resident will always be better off as compared to a non-resident for individual income tax purposes in Singapore. After we talk about all the type of taxable income, it is also important to note that for individuals, they are allowed to claim reliefs against their taxable income. Some of the very common reliefs include earned income relief, spouse relief, handicapped sibling relief, child relief, foreign maid levy relief, grandparent caregiver relief, parent relief, CPF contribution relief, life insurance relief, cost fee relief, national serviceman relief, supplementary retirement scheme contribution relief. For each of these relief, you will need to be familiar with the requirements. However, please also familiarize yourself with Appendix A of all the past year exam questions, as details of the relief will also be provided. Ideally, you should remember how to apply the relief rather than the relief amount, as the relief amount or deduction given are usually provided in the appendix. Please refer to the appendix for details for such reliefs. So here in the Appendix A of past year papers, there will be an insight to what will be provided in terms of the reliefs. So for the individual income tax reliefs, you will be provided with earned income relief, other relief, enhancement relief, your personal income tax rates, withholding tax rates, goods and services tax rate. So the strategy in dealing with the exam is to ensure that for those information that's provided in the Appendix A, you are familiar with it, but you do not need to memorize it by heart. You should spend more time remembering and memorizing information that's outside of the appendix, such as the application of such a relief, the conditions, etc. That will be more critical in the exam. So some note that will be provided, or rather that you should note in addition to Appendix A. For spouse, child, parent, and grandparent related relief, there is a need to ensure that the individuals do not earn more than 4,000 per income year unless these are handicapped individuals. For handicapped sibling relief, living with claimant or has at least incurred 2,000 in maintaining the handicapped sibling if the claimant is not living with the handicapped sibling. For clarity, the claimant here referring to the individual that is being subject to individual income tax and claiming the relief against its income. No insurance relief will be provided if your CPF relief exceeds Singapore dollars 5,000. Otherwise, the insurance relief that you will be available to you is actually 5,000 Sing dollars minus off any CPF relief you have claimed. For CPF cash top-up relief, relief is actual allowable amount topped up to the maximum of 16,000, 8,000 for self, 8,000 for family members. For grandparents caregiver relief, for working mom only, grandparents or parents should not be working, live in Singapore, and the child is 12 years and below. For the foreign maid levy relief, it can only be claimed by a working mother or an individual who is a woman. For those of you who are not familiar, foreign maid levy refers to levy that an individual have to pay when he or she hire a domestic worker, commonly known as maid, to work in the Singapore household. The other important aspect to note is that total allowable relief across all categories, no matter is it working mother child relief, spouse relief, you add up all the relief. If the amount exceeds 80,000, you can only cap it at 80,000. Lastly, parenthood tax rebate. So the first child rebate is 5,000, second child 10,000, third child onwards 20,000 per child. Take note, parenthood tax rebate is not a relief, rather it is a credit that's deductible against the tax payable of an individual. Apply it accordingly in the income tax return. Now, what are the conditions for parenthood tax rebate? So we talk about the first child being 5,000, second child 10,000, third child onwards would be 20,000. So it would be applicable to married Singapore tax residents, including divorcee and widowed individual who has a legitimate child born on or after 1st Jan 2008 and becomes a Singapore citizen at the time of birth or within 12 months after. Take note, if the child is not a Singapore citizen, the parent would not be entitled to relief even though the parent may be a Singapore citizen. Next, this rule also applies to what they call an illegitimate child, which basically means that the parents are not lawfully legally married at the time of birth, but it happened after, and the child becomes a Singapore citizen. You will actually be also allowed the parenthood tax rebate. For adopted child, similar situation applies, except that it can be applied to a child up to the 6 years of age, and it has to be a Singapore citizen either at the time of legal adoption or within 12 months after the legal adoption. Lastly, let us look at how to present an individual tax computation. It is critical to note that one of the expectations of the module is to ensure that you not only understand the individual tax concept, but is also able to present the individual income tax computation. So here we can see that you need to separately identify each of the type of income that you received and put it into the relevant categories. So first category we talk about is income from employment, where we will include every benefit that you receive as a result of your employment that is taxable, such as salary, bonus, allowances, any hotel accommodation or housing accommodation, and other taxable benefits. After we sum it all together, it will be your total employment income, and you have to call out your other sources of income separately. For example, either your royalty income or rental income from your own property. Those will form other sources of income. It has to be separately disclosed. After adding all your income source, you will come to a line called statutory income. And from statutory income onwards, you will net off any trade loss or donation brought forward from prior years, arriving at your assessable income. After assessable income, you will then deduct against all your personal reliefs that we just talked about, such as earned income relief, spouse relief, child relief, NSMN relief, CPF relief, leading to a chargeable income amount. And of course, after we have the chargeable income amount, we will then apply the tax according to the tier and the band that you're in, leading us to determining the tax payable. And here is where we apply the parenthood tax rebate. As mentioned, the tax rebate is not a relief, it's actually what I would commonly call a tax credit applied against the tax payable. And you will then reach your final net tax payable. Next, we will move on to look at a past year question from the examination. So this question is adapted from the December 2024 exam paper, question 2. Let's go through the question in detail. Tricia Tan is 52 years old and a citizen of country Y. She is a widow and was previously married to a Singapore citizen, Terence Tan, who passed away unexpectedly in 2021. The couple has been residing outside of Singapore for the past 20 years due to job opportunities outside of Singapore. Tricia was not successful in her permanent residence application in Singapore previously. In 2022, she accepted the role of Head of Investment at Compass Singapore Limited. Compass, a Singapore-based company offering global family office services. She arrived in Singapore on 20th November 2022 to commence employment on 1st December 2022. Due to family issues, Tricia had to terminate her employment contract with Compass prematurely, and her last day of work was 31st March 2023, the same day she returned to Country Y. For the period to 31st March 2023, Tricia derived the following income from Compass and incurred the following expenses and outlay. Monthly salary of 50,000. She returned 30,000 of the 100,000 sign-on bonus that was paid to her in November 2022. The company provided her with accommodation benefits as follows: hotel accommodation for November 2022, 5,000, and she was put up in company-owned accommodation rent-free from 1st December 2022 to 31st March 2023. The fully furnished company-owned accommodation with an annual value of 150,000 had previously derived a rental income of 118,000 per month. The company provided her with a rental car for her personal and business use from 1st December 2022 to 31st March 2023. The monthly hire charge of 4,000 was paid by Compass, and Tricia was given a monthly allowance of 2,000 to cover the running expenses of the car. Premium of 18,000 paid by Compass in 2023 on Tricia's medical and hospitalization insurance policy that Tricia negotiated into her employment contract. Tricia incurred the following expense in 2023 that were not reimbursed by Compass: business entertainment expenses of $3,200, running expense of $4,500 on the use of rental car for business travels, and taxi fares of $3,000 for business-related travels. There are 365 days in the year 2023. Tricia owns a residential investment property in Singapore for the past 5 years, which has always been rented out. During the year ended 31st December 2023, the income and expense from the apartment were as follows: gross monthly rental 8,000, annual fire insurance and property tax 6,500, monthly maintenance fee 400, replacement of refrigerator with similar features to the old appliance 900, mortgage repayment monthly of $3,000 comprising of capital repayment of 2,500 and interest of 500. Tricia will be claiming expenses on a simplified basis in respect of the property. Tricia has a daughter, Laura, who is a Singapore citizen. Laura is 21 years old and is currently studying at a university in New York under a scholarship awarded by Compass. During the year 2023, Laura received 120,000 of school tuition fees and housing allowance from the scholarship. Tricia's mother suffered a major stroke, leading to Tricia prematurely terminating her employment contract with Compass. Tricia had to return to Countrywide to support her father, who is the primary caregiver to her mother. Her parents are fully dependent on Tricia for their living needs. Tricia is also supporting her mother-in-law, who lives in Singapore, by bearing the cost of a foreign domestic helper who looks after her mother. The monthly cost amounting to 1,500 includes 60 for foreign domestic helper levy. Her mother-in-law draws 2,000 monthly from her inheritance bequeathed by her late son and continues to live in the property purchased by her late husband. The questions as follows. Determine Tricia's tax resident status for the year of assessment 2024 using qualitative and quantitative tests, as well as the relevant administrative concession. B. On the basis that Tricia is not a tax resident in Singapore for the year of assessment 2024, compute Tricia's net tax payable on various sources of income. For relief under Section 40B, both bases of computation are to be considered and you are to maximize the claims for reliefs available to Tricia. Show all relevant workings to support your claims, example, working mother's child relief, and provide your working showing the rate of claim applied on each child, if any, 15 marks. Here, I would like to pause to discuss the questions briefly. For question A, it is clearly a theory question that requires you to discuss Tricia's tax residency using two types of tests, both the qualitative and quantitative tests. Qualitative tests, as a reminder, discuss the qualitative aspects of Tricia's tax residency, such as her connection to Singapore and whether or not she's ordinarily residing in Singapore due to her nationality, etc. Quantitative test is clearly test based on the physical numbers of days or employment exercise in Singapore and includes the 2 years and 3 years administrative concession. You will need to note that there is a highlight here on relevant administrative concession, given the fact there's one admin concession that you do not need to discuss. That would be the 3-year administrative concession, as clearly Tricia only stayed in Singapore, straddling across a 2-year period. On the second question, it is basically to set up Tricia's individual income tax computation, setting up all her taxable incomes and reliefs available. One thing to note is the question has stated that you will treat Tricia as a non-resident. So regardless of your answer in A, please note that for B, you have to treat Tricia as not a tax resident in Singapore. I'm not saying that this would be a preclude to your answers in A. Some students may think that perhaps it is related. I would say, out of abundance of prudence, treat them as two separate questions where answers in A should not affect the assumption, given that the questions has clearly stated that you are to treat Tricia as a non-resident for the purpose of Part B. Now, we will move on to talk a little bit about Part A. So Part A's question again require us to discuss her tax resident status, meaning you need to give a conclusion using two types of tests, qualitative test and quantitative test. As you can see in the suggested solution, first, we will talk about the qualitative test. Clearly, Tricia cannot satisfy the qualitative test as she has not demonstrated that Singapore is a normal place of residence. She has not lived in Singapore for any prolonged period of time and clearly not a Singapore citizen, neither is she a permanent resident. So without any national sort of right to work and right to stay in Singapore, she cannot be indefinitely in Singapore as she is not a permanent resident. So from a qualitative standpoint, the overall connectivity to Singapore does not exist and she did not pass the qualitative test. Then we move on to look at the quantitative test. So in year 2023, which is the year preceding YA 2024, clearly she was not physically present nor exercising employment in Singapore for at least 183 days, which basically means that she has to stay for at least 6 months and above. The actual number of days, if you compute based on the facts, it's going to be 90 days. Therefore, she has clearly failed the quantitative test. The applicable 2-year administrative concession can be applied because she actually stayed in Singapore for 2 consecutive years. But even if we count the consecutive years, she did not live and work in Singapore continuously for more than 183 days over the 2 consecutive years. Therefore, in conclusion, she also failed the quantitative test. As a result, Tricia should not be considered as a tax resident of Singapore for the year of assessment 2024. As you can see, there is no expectation that even for 10 marks question, you have to write a very long response, but it will be good to ensure that the key concept that is flagged here is available in your answer. You can write your answer in a more story-like narrative to give credibility or make it like an advisory note to the client. That is fine. Now we'll move on to the second part of the question, which require you to prepare the individual income tax computation for Tricia. So here you have a situation where your basis period, right, would be between 1st January 2023 to 31st December 2023, which is her YA 2024. So clearly, what is taxable here would be salary, where the amount of salary that she received would be taxable, and the sign-on bonus that she received would also be deductible because she actually returned the money back and she didn't enjoy the benefit. Therefore, we will reduce that amount from her tax liability. Next, for the accommodation benefit, it is prorated based on the annual value and the number of days that she was given the benefit. Rental car also prorated accordingly. Her transport allowance and her insurance and medical premium, adding up to a total employment income, and less deductible expense she incurred for her employment income, leaving us to a net employment income of 198,422. It is very important to note here that the first basic rule of preparing an individual income tax computation is you need to categorize the type of income. Here, we are talking about Tricia's employment income with Compass. Do not mix in or include any of her rental income. It may sound a bit of a common sense, but I have seen many who just decided to do all the income type together, and that's not how you present an individual income tax computation. You may get the final answer correct, assuming that you're able to grasp the concept, identify the taxable amount, but the presentation format would also be penalized in your final grades if you do not consider presenting it in the right format. Therefore, my emphasis for this is do note that you are required to present each income type by category, starting from employment income down to your net employment income, and then you may have other income source that you need to identify separately, such as in this particular question, later we'll go move on to discuss. She does have an investment property in Singapore in which she derived rental income. So that clearly is also a source of income that we will cover here. So next will be personal relief, resident basis. So what are the available relief that she would be able to derive? There will be earned income relief, child relief, working mother child relief, as well as the parent relief for her mother-in-law. Do take note that the total relief she's claiming is 40,000. Therefore, she does not actually be affected by the 80,000 cap. So after you deduct her personal relief, there will be the chargeable income of 158,000 and $159. Tax on the first 120,000 is 7,950, and the tax on 38,159 at 15%, that would be 5,723.85. And that totals up to 13,673 and 85 cents. So when you less off, right, the total your personal tax rebate for the year of 200, you will derive a notional tax payable on the residence basis of 13,473 and 85. However, when you apply the 15% flat rate on your taxable income, you will arrive at 29,763 and 30 cents. Clearly, you need to show that you have done the notional tax payable and the final tax payable on the employment income, whichever is higher. Recall earlier where we talked about the fact that the basis of having a tiered income for resident individual and a flat income for non-resident individual is to provide a relief and benefit to the resident individual. Therefore, for non-resident individual, you need to be taxed on the higher on the either of basis. Here in this case, clearly, when we apply the either or basis, the 15% flat on taxable income is higher. Therefore, the final tax payable in this case should be 29,763.30, which is the higher amount. After we conclude on the employment income, then we look at the rental income, as mentioned earlier. She's deriving $8,000 a month and 12 months on an annual basis, 96,000. She has opted for a simplified expense claim where it will be 15%, right, of the income as deemed expenses, and she can clearly claim the interest expense associated with the loan that she financed the property on, leaving a net rental income of 75,600, subject to a tax of 24%, giving an amount of $18,144. Now, with that, we will be coming to the end of the individual tax webinar. To summarize, I hope this webinar was able to provide you with an insight to one, the importance of the concept of determining tax residency for an individual, how the two tests of tax residency, both the qualitative test and the quantitative test, will be applied to any individuals that we would like to talk about during the examination. Next, we also look at the types of income which are taxable in Singapore, what's the nexus to Singapore, the exemption of the type of income that is derived by individual in Singapore. We further move on to talk about the reliefs available to both resident and non-resident individuals in Singapore. And last but not least, we examine and understand the format of the individual tax computation. One thing that I would like to highlight is, for the purpose of the upcoming exam, please familiarize yourself with Appendix A, which contains all the information that the examination will provide, and ensure that outside of what's being provided, you understand the conditions and the rules, such as the rules for working mother-child relief, the fact that all personal relief are to be kept at 80,000, etc. If this information are not ordinarily available in Appendix A and is critical, you will be rewarded for remembering them. Last but not least, wishing you all the best and looking forward to guide you along in the next module. Thank you.